In this introduction to basic LBO math, I would like to introduce you to some of the concepts that underlie the financial considerations in a leveraged buyout transaction. Those concepts include projections, or sometimes more colloquially referred to as the model. And the model is essentially a spreadsheet that contains the investment professional's expectations as to the future financial performance of the company being acquired, focusing in particular on the company's ability to generate cash. The concept of cash flow is central to a leveraged buyout's financial considerations and is often referred to more specifically by the technical accounting concept of EBITDA or EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. And we will talk a little bit more about what that exactly means in a moment. We'll also run into the use of a concept called multiples. We'll see that in several places. For example, we sometimes talk about a purchase multiple or a exit multiple or also a leverage multiple. And in all those cases, what we're referring to is the number of times something like purchase price, sale price, or the amount of debt being incurred in connection with a transaction, the number of times that number represents as a multiple of some other number, and that other number is usually cash flow or EBITDA. EBITDA multiples are a central concept that we'll see in LBO Math, as we'll see in a moment. Let's talk about projections. What we have here is a simplified version of a leveraged buyout model for the BGI Volt Process Design Company deal. And as you can see, this is a set of projections. And what we find is that for each of a series of years, so the past year and then each of the next 5 years thereafter, we have certain metrics regarding the financial performance of the business set out. And let's focus just for a moment on the historical numbers, right? Where do these come from? Well, these are the actual reported historical results that would be reflected on the financial statements for the company. And so last year, Volt had revenue of $472 million, as we know. And all of this are the other financial metrics for the business's performance last year, yielding a result of a net EBITDA or EBITDA, or earnings before interest, taxes, depreciation, amortization, of approximately $211 million. All right. Now, what is this? This is basically the income statement, the profit and loss statement from the business, starting, of course, with the top line, revenue, which represents the subscription payments that the company's received and other payments it's received for the services and other products it sells to its customers. Net of its cost of revenue, which in this case, since they're a software business, that would be the money that they spend on the ongoing development and maintenance of the software, netting a gross profit of $423 million, and then subtracting $212 plus million of expenses, which in a software business would generally consist of selling, general, and administrative expenses. So this is their marketing spend, this is their corporate offices spend, this is the spend for just the general costs of running a software company, leaving net income, right, so of $211 million, right? In order to get from operating income to EBITDA, what we do is we add back a non-cash charge called depreciation and amortization, And when you take operating income, which is also comparable to the concept of EBIT, right? So operating income and EBIT are equivalent in most cases. EBIT being earnings before interest and taxes, right? And all of this, so far, we have not taken into account any interest costs, and we've not taken into account any tax costs. And so that's EBIT or operating income. But to get to EBITDA, which is earnings before interest, taxes here, depreciation, amortization, we would have to add back any depreciation, amortization if there were any. But as is not uncommon for a software company, there is none in this case. Depreciation is the charge that a company takes every year for the declining value of its investments in capital assets. That's a fancy way of saying that, hey, if you own equipment or you own a building, that equipment or that building doesn't suddenly get used up right away the minute after you've bought it. It's different than, for example, salaries, which are immediately paid and used up and consumed. When you spend money on things that have a capital value, meaning they have a useful life longer than a year, the accounting people tell you what you got to do is you got to spread the cost of that asset over its useful life. And so, for example, if you have a piece of equipment that has an assumed life of 5 years and you spend $100,000 on it, well, you expense only $20,000 of that $100,000 you spend against your income that year, because you have to spread that $100,000 cost over its full lifetime, right? Because you're not going to spend another $100,000 every year. You're going to spend the initial $100,000, and then it's going to get used up over 5 years. And so you allocate that $100,000 investment over its useful life. But because that accounting charge, which, yes, from an accounting point of view, does affect profit, but because it's actually not a use of cash, right? It's an accounting entry, right? You've already spent the $100,000, and so there's no new use of cash for reasons that will become perhaps more obvious. In an LBO model, you tend to add back non-cash expenses like depreciation, amortization, to get a cash flow number or EBITDA number that shows, okay, how much cash, right, actual, folding paper money is left at the end of the year from this business, assuming this level of revenue. Okay. Now, we are mentioned earlier that EBITDA is a very key metric, and we'll see why in a second. But what the primary purpose of a set of projections, since these are historical numbers, they are what they are, that was last year. The real focus of a set of projections or a financial model is on the future, right? And what do we see here? All right, we took last year, that was off of the financial statements, but then we came up with a statement of what revenue, cost of revenue, and so on, all the way down to EBITDA, is going to be for each of the next 5 years. All right, that's typical. You could go longer, but the usual financial model looks out 5 years. And where does this come from? What's it based on? Well, and the answer is, in general, it is based on a bet, an assumption, a best guess, if you will, a set of predictions that are established by management in conjunction with the investor, in this case BGI, right? That tells a story about what the company thinks it's going to be able to do, primarily, firstly, in terms of revenue, right? So in this story, as shown here, what is going on is the management team is saying that at the end of next year, after the deal closes, revenue is going to grow by 10% from the prior year, all right? But then at the end of year 2, that rate of growth is going to double. And so revenue is going to grow not 10% from year to year, but instead now 20. In year 3, that rate of growth is going to accelerate even more to 25% and stay up at 25% for 2 years, and then ratchet down back to 20% growth, but still faster than the first year of growth. And if we had the prior years set out here, so the actual historical numbers, you'd see that Volt was doing around 10% per year revenue growth. And so what this set of financial projections assumes is that in the first year after the acquisition, the historical trend of the business is going to stay consistent, but then something's going to change. And that change is going to result in an acceleration of the growth of the business. In other words, they're going to get a lot more customers. They're going to sell a lot more software than they have historically year over year. And why is that? Well, the assumption is that by the end of year 1, they'll have had in place their strategy for penetrating the China market, which, as we heard, is a substantially untouched but enormous potential market for the business. And as a result of that, their rate of growth is going to change and increase, right? And frankly, they'll argue that they're not being as aggressive as they could be, as optimistic as they could be, because they're only doubling the rate and then a little more for a few years, and then it's flattening out again, right? And so they're not expecting, huge growth, but quite a bit substantially more than they were historically. Okay. Now, where do they get those numbers? Well, truth is, it's a guess. It's a prediction. And the truth is, you'll see more than one model prepared by a client. This one, we'll call it the base case. Right? What's that mean? Well, that's the case that management and the team is going to use for actual planning purposes. And we'll see in later exercises how that works. Right. So, for example, it will be used to establish financial covenants, or to establish the budget, or perhaps to establish bonus plans and things like that. Right. So this is the central case, the one that we're all going to assume is the one we're going to work from. But of course, if you asked Kay Sun, she would say, nope, this is a very pessimistic case. There is a much higher outcome case. So I'm sorry, called the upside case. And that would arise if, in fact, these numbers weren't 10, 20, 25, 25, but maybe 15, 25, 30, 35, right? So if China turns out to be, a place where they can actually double their business and not much more quickly, or triple it or so on, that's an upside case, right? But what we're saying is, because we're going to use the base case, we're not counting on that upside case. That would just be, gravy, if you will, from the investor perspective. And just like there's going to be an upside case, there's going to be a downside case, right? And the person who's going to prepare that primarily and focus on it is, unsurprisingly, the lenders. The downside case is, okay, worst case scenario, if things go poorly, what happens? Or another way to think about it is, they'll do stress test cases where they ask themselves, how poorly does this top line have to actually turn out to be before it becomes a problem to pay back the debt, right? And people will look at those downside cases to see whether or not the risk of default, and we'll talk about what that means later, is significant. But let's just focus for the moment on our base case and see what's going on. All right. Now, we talked about how revenue is being projected to grow, and we talked about how that set of projections is based on the story of the increasing opportunity of penetrating the China market. But what's going on with the other metrics? So what happens to cost of revenue? Well, you'll see that what happened was the historical number was 10.3% roughly. So meaning historically, the amount of money the company spent on maintaining the software that was underlying the subscription revenue was around 10.3% of those revenues. So for every dollar of revenue, 10.3 cents had to be spent on cost of revenue expenditures. And what we see is that in these projections, we are changing that assumed rate of a cost to a little higher, 11%. And the story there is that the management team is being a little conservative because they're assuming that the cost of maintaining the software in multiple jurisdictions, and in particular, perhaps because of the language requirements and the need to maintain Chinese language version of their software, might increase their cost of revenue. And so they would argue that this bump here is a conservative assumption on their part. Similarly, notice how operating expenses, so historically 45% roughly was the amount that the company had to spend of its revenue to run its operations. And again, being conservative, the team has decided to bump that as a percentage of revenue by 2.5 percentage points. And then having it scale down over time as scale is achieved back to the original 45% level. So really what they're saying is it's going to be more expensive in the early years as they ramp up their new operations and their new sales force in China. Right? So arguably a conservative story. Now, whether these numbers are correct and whether they're based on reasonable assumptions, that's something management and the investors would have had to discuss. But this is their base case scenario. Now, of course, people will again do upside case scenarios where they manage to spend less and downside cases where they manage to need to spend more. But this is the base case. We notice that a little bit of depreciation creeps back into the model. Why is that? Well, that's because we saw down here that the company is going to do a little capital expenditures, i.e. it's going to make investments in long-term assets in the next couple of years. And what's that? That's them building out their offices in China. And so they're buying some, equipment, furniture, and so on, right? But not a very significant item. Again, depreciation and amortization tends not to be a big item in software businesses because there's not a lot of capital equipment required to run the business. It's a very people and intellectual property oriented activity. Okay, so that's where our EBITDA projections are coming from. So these are probably the most important set of numbers here. Let me get a nice pen that everyone's focused on. This is probably the set of numbers that are going to drive the deal, and you'll see why in a moment. But what else do we have on the model? Well, once we get past the historical period, and now we're talking about future periods, we also start asking ourselves, well, what's the story with the ability to pay back debt? Okay. And so, in other words, we were at EBITDA. Well, let's take away the I in EBITDA, which stands for interest, i.e. that's one of our uses for cash flow, is to pay the bank and the sub-debt the amount of interest they're entitled to, and that's calculated here. And the reason it goes down is because we assume we start paying back some of the debt over time, and so there's less interest. And then we assume that the company, because it has net income at the end of the day, is going to pay some amount of taxes. Here we're assuming 30%, which may, given recent changes in the tax law, be high. But in any event, that's the assumed rate, state and local included. And so those are the most obvious uses for cash, right? So EBITDA minus interest and minus taxes yields cash flow from operations, right? So that's what's left to be used to pay down debt or otherwise make distributions to investors. And in this, and also what's available to make investments in capital expenditures, right? But as we said, we didn't think they'd be particularly big, except for a little bit in the first couple of years where they're opening up offices. And so what they're going to have here is roughly 60-some million dollars of cash at the end of the day after their first year, after having paid their interest, paid their taxes, and done what capital investment they need to do. They have $850 million of bank debt and $500 of sub debt, but they're not going to pay any of that off the first year, we're assuming, in this model. And so they'll end up with $62 million of cash balance at the end of the day, right? So not spectacular in that they've not reduced their debt, but pretty good in that first year, without a significant change in the revenue number, they still manage to cover their interest expense and their capital expenditure requirements. Okay, but obviously this is telling us something about what the terms of the bank loan have to be. For example, one thing we now know is the bank loan has to have no amortization, no required principal payments the first year, or else if that was different, the model isn't quite working. All right. But the big question, of course, is, does it pay down debt? Is it servicing the debt? And one assumption most people want to see fulfilled is that the bank loan gets paid back in full over the life of the loan, so in 5 years. And here we see in our model, while the sub debt remains outstanding all 5 years in its original principal amount, the bank debt gets paid to zero, right? And while maintaining a substantial cash balance on the company's balance sheet. And how does that happen? Well, as we see each year, EBITDA grows quite substantially because revenue grows, right? And as revenue grows, because the other costs are relatively fixed as a percentage of revenue, EBITDA grows. Interest expense, on the other hand, goes down because as we pay off bank debt, the amount of interest we owe to the bank goes down because then we generate increasing amounts of net income or operating income or EBIT, so income before, I'm sorry, not EBIT, but income before, earnings before taxes. We now have increasing amounts of tax payments, okay. A rich man's problem. And so our cash flow gets bigger and bigger and bigger, right? And because we don't really have any CapEx, what do we do with that cash? Well, we use it to pay down debt, all right? And so you see here, although we didn't manage to pay any in the first year, we're going to pay $100 million back the second year, $175 the third, $250 the fourth, and $325 in the final year. And that has us retiring the entire amount of senior debt over the 5 years of these projections. And so as a base case, right, we have success in that the model assumes, if achieved, we'll have the ability to cover our cash needs and pay down debt. Okay, so we've talked about what projections are and what a model is, right? And we've seen how the focus of those projections is going to be on calculating and projecting EBITDA, right? And we've talked about how one of the primary purposes of understanding projected EBITDA is in order to analyze whether or not you're able to service and then ultimately repay your bank debt. And so what we haven't talked about so far from our list of basic LBO math concepts is multiples. So let me show you something. Here we have a sheet that shows some basic statistics from our deal, right? We show ourselves purchasing the Vault business for $2.25 billion, including the rollover equity. We show ourselves spending about $100 million in expenses, which then generates a total purchase price, so the total cost of getting the deal done, of $2.35 billion. We show that $850 million of that $2.35 billion purchase price is being funded through bank debt, $500 from sub-debt, and some other statistics we'll talk about in a second. Here in particular, the cost of the bank debt, so a 6% interest rate, and the cost of the sub-debt, a 9% interest rate, which, by the way, is how we calculated these numbers, right? These are simply paying the 6% on the bank and the 9% on the sub-debt as it declines. Okay. And then we know that in order to fill the gap between the total cost of $2.3 billion and the borrowing of $1.35 billion, we need $1 billion of equity. Okay. But so what are these numbers, right? They are the multiples, or the entry multiple in this case, right? We'll call it the purchase multiple. And what is the purchase multiple? The purchase multiple is the number that you'd have to multiply the assumed level of EBITDA. In this case, I'm using the first year's projected EBITDA, right? So what number would you multiply that number by, EBITDA, in order to get the total cost of the deal? Right? So our purchase multiple, our entry multiple, also sometimes called, in this case, is 10.7. Right? And simply, this number divided by this number means 10.7, or said differently, we are paying 10.7 times projected EBITDA for this business. Right? Now, why is that significant? I mean, it's just simply a mathematical calculation. But what that number allows us to do is to compare this transaction and the valuation that's implied in this transaction with similar transactions in the marketplace, right? And so when people think about comparing one deal versus the market, if you will, for deals of this kind, one of the statistics they almost always want to know about is, well, what's the entry multiple, the EBITDA multiple, right? Because what they want to see is a multiple that is consistent with, in the range of, similar comparable transactions, because that gives them comfort that the price that's being paid is, from the perspective of the buyer, not too high, and from the perspective of the seller, not too low. It's the just right Goldilocks number. In leverage buyouts, you tend to see range of multiples somewhere from 6 to 12, and that seems like an enormous range. How is that helpful? I mean, well, one thing we know now, at a multiple of close to 11, we're at the high end of the range. Does that mean we're overpaying, or that Rachel and company and family are doing too well? And the answer is no, because within this range, you would expect to see very different kinds of companies. Leverage buyouts of companies that are fairly low growth, that have very slow and predictable and non-high growing revenues, tend to be in the 6 to 8 times range. These are the more traditional buyouts, where you're buying fairly boring, mundane businesses and looking for most of your upside through financial engineering. Whereas a different kind of buyout, which the Vault belongs to, is in the sort of high growth deals, where there's a substantial upside associated with a change in the revenue of the business, and they tend to be more in the 10 to 12 times. And you can imagine a software company is more likely to be here, whereas a boring manufacturing company is more likely to be here. And so given the nature of the business, we're not surprised to see that it's in the higher end of the range. But all of that comparability, that ability to sort of talk about how this deal fits within the range of deals, is driven by the multiple. The other two multiples we see here are forms of leverage multiples. And all they do is represent the ratio that this amount of debt represents to the EBITDA level we're focusing on. So in this case, we are borrowing about 4 times EBITDA from the bank and a little over 2 times EBITDA from the sub-debt lenders, and have a total leverage ratio of about 6.2, right? That's a little high, I would say. But what is that? Why is that important? Well, the higher this ratio is, the more risky this debt becomes, right? Because that means there is less as a percentage cash available to service and repay debt, the higher the ratio is, and therefore the more risk is involved in that particular loan. And in setting interest rates, right, there is a market, and in order for a market to work, you have to have the ability to compare loan to loan to loan to loan. And one of the principal factors that gets used to compare loans to each other is leverage ratios. And so there is a strong correlation between this leverage ratio and this rate of return, right? So the higher this rate, the leverage ratio goes, the higher the debt rate will be, the interest rate will be, up to a point where they simply won't do the deal because it's just too risky, right? So again, leverage multiples are a way of comparing different loan structures deal to deal to deal, and a way of allowing the market rate to be determined for a different each different transaction. The one other multiple we have not talked about is called the exit multiple. And it is the multiple that tells us what the expected return is for this group. Perhaps from the point of view of BGI and Rachel Richards, the most important multiple of them all. So to understand why exit multiples are so important to investors, let's look at this spreadsheet. What I have here is a matrix that shows for each given year, each of these columns is a year, right? The expected exit value for a Volt process design company. Now, what do I mean by that? Well, just like we purchased the business for a entry multiple of 10.7 times, you'll remember that, right? We bought it for 10.7 times, 2.35 billion was 10.7 times 220 million of EBITDA. We would expect that the next person to buy this business is going to buy it for some multiple of the then current EBITDA, right? And since we have a set of projections for each year, right? Year 1, 2, 3, 4, 5 of what EBITDA is going to be, we can calculate what we would expect the purchase price for the business to be when it comes time for BGI to sell the deal, to flip it, right, and to take its money off the table. And the way we would do that is we take the projected EBITDA and we multiply it by some assumed exit multiple, right? So, and for illustration purposes, we decided to use a 6 times, an 8 times, a 10 times, and a 12 times. And these are simply assumptions, right? And we'll see what effect different exit multiple rates have on the value of the deal from the perspective of the investors, right? And so obviously, as the exit multiples go up, right, so do the valuations. And similarly, as the EBITDA levels go up, so do the valuations. More EBITDA, bigger price. Bigger multiple, bigger price, even if the EBITDA is the same. Now, those of you who are sitting there with your calculators and trying to simply take 220 and multiply it by 6, you're obviously not getting this number. And you're saying, well, what's going on? Why is it? Didn't you just tell me that what these numbers are EBITDA times the multiple? And the answer is they are, but they are subject to one further adjustment, right? Because when you sell your business for its purchase price, yes, that is what we call this number times this number yields what we call the enterprise value for the business. But the problem is that at that point in time, a year from now, we still have $1.35 billion worth of debt, right? And so we have to take the enterprise value, which is the multiple times EBITDA, and subtract the debt, because you have to pay the debt off. And no one's going to buy the company subject to the debt without taking an adjustment in the purchase price for the amount of debt they're assuming. Or more practically, you have to come up with the money you need in order to pay the bank off and to pay the sub-debt off. Now, you do get a small offsetting credit for whatever cash is on the balance sheet, right? And so what really each of these numbers are, so on, are the multiple times the projected EBITDA minus the bank debt at that time, minus the sub-debt at that time, plus whatever cash, right? So that's what each of these cells tells you to be the case, right? And so as EBITDA grows, so does the valuation. As debt gets paid down, so does the valuation also grows. Those are the two big drivers of what these numbers turn out to be. Now, well, and then of course, the other big driver is what's the multiple, right? So now why would we think the multiple would change? Well, remember in our projections, we showed very significant growth for the first couple of years, and then it starts to tail off, right? And at the end of year 5, we're seeing growth turn around and start to decline a little bit, although still quite significant. And so when you have a story like that, you would expect that the multiple that someone's willing to pay for that business to go down, right? And if we were paying 11 times or 10.7, maybe it'll drop to 10, maybe it'll drop even to 8. Other reasons why multiples might change, well, multiples change from market to market. In a very bullish market like we have at the moment, multiples are very high. But in a world where price earnings ratios and other market factors are shifting downward, where it's less bullish, all multiples will shift downward. And so it may be the case that when it comes time to sell Vault, we're in a down market and therefore can't expect the same kind of multiple we had to pay in order to buy it in a bullish market, right? And so part of what we're doing here is testing how resilient our investment returns are to shifts in the market multiple or the exit multiple. All right. And so what I've highlighted are a few examples of where it is the case that we do pretty well. All right. And what do I mean by that? Well, what does MOIC stand for? MOIC stands for multiples of invested capital. Right? And what is invested capital? Well, in our case, it's the equity contribution by the equity investors, the first $1 billion. Remember, we were saying we had not yet answered the question, what are these guys getting? We know what the sub-debt's getting. We know what the bank is getting. What are these guys getting? And the answer is they're getting a multiple of their invested capital. And in this case, for example, if they only get to sell the business for $35 million net, well, obviously $1 billion in and 35 million back is a bad deal, right? Anything less than a multiple of 1 means they didn't even get their money back, all right? But anytime they have a multiple greater than 1, they are actually making positive returns. And in the leverage buyout business, if you're making more than 2.5, 3, or more times your money, you've done pretty well in a 5-year horizon, all right? And so I've highlighted each of those scenarios where the investors in this deal will be very happy, all right? They'll still be happy, okay happy at these levels, right? Because they're still making a decent return on their money. But once you get into the 2.5 to 3 and more times your money, and we can talk about where that calculation comes from, but it's essentially another way of calculating the percentage rate of return on your money, right? So if 2 years from now you get 2 times your money back, well, what does that mean? That's what? That's 100% return in 2 years, which is, pretty good return. There are not a lot of investments that do that. Obviously, if you get 2 times your money back 5 years later as opposed to 2 years later, that's a substantially lower annual percentage return, but it's still pretty darn good. Okay? And so the question is, if these are the scenarios where the exit meets our return requirements as investors, what does it tell us? Well, it tells us that even in a down market, call it 8, right? As long as we meet our projections, we're going to do exactly what we hope to do, right? And if we are lucky and the market retains the same multiple that we're paying, we're going to do spectacularly well, right? So 5 times our money in 5 years is a very, very high percentage return. And so this is the kind of math that drives folks like BGI to do a deal like the LBO of Volt Process Design.